Coldwell Banker, who at the time was probably the the best operating brokerage firm in really the Western United States, one that Mott was very familiar with. I should have asked for your help. But I applied for the job, and the job process takes you through about 8 different interviews and personality tests. I didn't make it past about the second interview. I was told to find a new career. But the guy who eventually got the job is right there. And Chris was actually my roommate at the time. After Cal, we moved to Montclair. But I was a commercial real estate broker there in the Bay Area for a couple years, and then followed my wife down to San Diego, where I continued to work as a commercial broker for about 10 years. And then in 92, 93, I connected with a couple of guys, a Leighton and a Belly, who I'd known socially and professionally. And they had just started a company that was really focused on helping lenders take on challenged assets that our economy was in a very difficult time then. Me and another guy joined. We became the associates. The firm was LBA, and we transitioned that business out of helping financial institutions to investing capital on behalf of institutional investors, predominantly in the industrial space and in office buildings. And we are about to celebrate our 30th anniversary, and we now have close to $7 billion of assets under management. We have a portfolio of about 65, growing to 70 million square feet here in the next 6 months, sort of across the country. Again, our focus is predominantly on industrial and office space. Chris Watson.
Chris.
Thanks, David. And to echo Mott's comments, it's really rewarding to have the connections that we maintain that have lasted 40 plus years. I'm still recovering from duck dinner last fall, where the illustrious pledge class of '79 celebrated their 40-year anniversary, and proud to say we almost had 100% attendance, so that's pretty good. As David alluded to, my early success at CB has been eclipsed by David's future successes, but I started my career much like David did as a broker, working in the East Bay submarket of the San Francisco Bay Area. About 10 years after I was at CB, I went to work for a client, and we built a portfolio of office properties, which we rolled out as a publicly traded REIT in 1996, and that coincided with the REIT capitalization phenomena that was started around the mid-1990s, where portfolios of real estate became the assets, the underpinning for these publicly traded companies, and afforded many private citizens an opportunity to invest and own professionally / institutionally managed real estate. From there, went to work for a private real estate investment company based out of Marin with a couple of friends of mine. We grew a portfolio of office buildings to about 5 million square feet of Class A buildings. We sold that company to US Trust, which is a New York-based wealth management company, because they wanted to be able to introduce real estate as an asset class to their clients and provide a diversification alternative for them. And about 10 years retired from the firm. It was called Mayer and Siebel, and partnered up with a FICAP from Cal named Kurt Setzer to just go out and acquire properties in the Bay Area and not have to get on airplanes and travel around anymore. So with those introductions, what David and Steve and I wanted to try and do today is give a very broad brush overview of the real estate economy, breaking it into various sectors. I'm going to speak a little bit about the hospitality industry and multifamily residential. David is going to talk about student housing, something that's near and dear to his and our pledge brother Todd Whitlock's hearts, as they're developing a very unique property in Berkeley on Telegraph Avenue right now. David will talk a little bit more about the office and industrial sectors of the real estate economy, and then Mott is going to tie everything together with his expertise in technology and what's being done vis-a-vis going back to work and making the workplace safe. So with that, we'll blow through our little brief presentation, and then would welcome any questions from you guys towards the end. So let me begin with the hospitality industry. 2020 was expected to be a bellwether year globally for the hospitality business. The World Tourism Organization anticipated that there were going to be 1.5 billion hotel arrivals in 2020, which eclipsed previous best by over 500,000 visits. Of course, everything was put on hold, and the direction changed very, very quickly with the outbreak of COVID-19. And as we look at COVID-19 impacting, basically every industry in every country in the world, it's safe to say that there's probably no industry other than the travel industry that has been hit harder. Airlines, cruise lines, the hotel hospitality industry have been decimated. And easily focusing on just the United States, it's had quite an impact. Leading up to COVID, the hotel industry employed about 4% of the U.S. labor force, almost 8.3 million people. And since the pandemic has hit, 3.5 million of those jobs have been lost, and an additional 2 million, actually 1.9 million of those jobs have been furloughed. So a very, very significant impact, from a personal standpoint of these people losing their jobs. That equates to close to $2.4 billion in weekly lost wages just from the hospitality sector alone. Consider the various types of hotels that are out there. Select service or limited service hotels have gone from an average of about 20 employees down to 7. More full service hotels that you might find in urban city centers that cater to the business traveler or the traveler who is interested in a higher end hotel have gone from about 50 to 14 employees, and the hardest hit has been the resort sector, which has gone from an average of about 90 employees down to 5. Today, 8 in 10 hotel rooms are empty, and the occupancy that's projected for this year is lower than it was in 1933 during the Great Depression. To put things in a little bit more of a current perspective, the industry expects that the impacts of COVID will be 9 to 10 times worse than what was experienced in 2001 following 9/11. In 2001, there were 400,000 hotel jobs lost, and the occupancy rates averaged 59% in 2001. In 2020, as I mentioned, we've got between 3.2 to 3.9 million jobs that will be lost permanently, and the additional jobs that will be furloughed with 25% occupancy. So this is generally regarded as probably what will be the worst year ever for the hotel industry. Since mid-February, when travel stopped, the hotel revenue hotel industry, has lost about $31 billion in room revenue, and it's on pace to continue to lose about $400 million a day. So pretty significant. The other thing that is equally as important is important. We're getting.
We do some of our best work like this.
So 61% of the hotels in the United States are characterized as small businesses. These are, businesses that are on a shoestring, capitalized very moderately, and with occupancies expected to hover between 20 and 25% for the year, and the industry looking at 40% occupancy levels as the minimum criteria to stay open. There's approximately 33,000 hotels that are at risk of closing. Since April, operating profits for the sector dropped almost 120%, with average, daily daily rates going from about $132 down to $82, and RevPAR, or revenue per occupied room, plummeting over 65%. As we recover, and I think as I speak about hospitality and also multifamily, the speed with which the recovery happens and the robustness of that recovery is going to certainly have a great impact. Not something that I think anybody can measure right now, but as the as the economy recovers, I think the most vulnerable sector of the hotel hospitality industry is probably the full service downtown urban hotel that's dependent on business group travel or convention business. There are a number of conferences, if you just look at San Francisco as an example, or Las Vegas as an example, that have been canceled, and the impact has been severe and broadly felt. Gateway markets that rely on international travel are also going to have a tough time coming back, and hotels that are proximate to airports that used to enjoy very, very high occupancy rates will be vulnerable during the recovery. It goes without saying also that the small independent hotels that are marginally capitalized will have a tough time making it through this downturn. Less vulnerable will be hotels that primarily rely on transient, the transient segment of travel. These are drive-to markets. They're select service hotels. The well-capitalized brands that have capital resources or the ability to raise capital should do reasonably well. And then, the economy and sort of mid-sized hotels should do well. It's expected that coming out of this crisis, that the two hotel groups that will be best positioned will be the resort properties. Once travel begins again, people are going to need to try and forget everything that's been going on and continues to go on. Expected to recover quite quickly. Is the hotel, and that is a segment that is seeing new development, whereas a lot of the rest of the hotel or hospitality sector has essentially shut down on new construction. Most of the pundits are expecting that we're looking at a 2.5 to 3 year recovery based on the damage that's been done in the last 90 days. Again, that's a broad brush comment, but it is expected that it's going to take some time. As I mentioned, there's very limited new development anticipated based on the fallout of COVID. And I think a very unique opportunity has presented itself in that a lot of these existing properties have been trading at valuations that are very well below their replacement cost, and may present an opportunity for established brands to go in and expand their footprint over time. Interesting that the conversion of hotel properties has been contemplated, but not really embraced, because hotels present such a great tax revenue base for the municipalities in which they're located. Many of these cities are very reluctant to see these hotels turned into an alternative use. Shifting real quickly to the multifamily residential side, housing, whether it's home ownership or renting of apartments, is directly impacted by employment. And COVID-19 has resulted in the worst job loss that we've seen in the United States. There's approximately 36.5 million jobs that have been lost, resulting in an unemployment rate that's approaching 15%. Many of these job losses are regarded as temporary, but still, COVID is influencing all housing markets. Unemployment, for example, in the Bay Area, San Jose is 12%, LA is 13.2%, Los Angeles is at 18.8%, and then the worst city in the country at this point appears to be Las Vegas with 33.3%. So those are pretty staggering numbers, and again, it's not really known how long this unemployment will last, but somebody's ability to pay their mortgage and or rent is dependent on their cash flow situation. So to be determined. It's interesting, 2020 first quarter data suggested that U.S. home ownership had reached its highest level since 2012. It was at 65.3%, the highest ever was 2005 when it was approaching 70% at 69.4%. It's expected that the economic disruption from COVID will lower the trajectory of home ownership, but it's interesting to note that home ownership still is appealing across the country. Didn't realize it, but Los Angeles has one of the lowest home ownership rates in the country at less than 50% at 48%. Don't know why that's something I brought up, but
It's good with tents, though.
They are very good with tents. Very good with tents. So what does all this mean to the multifamily market? Well, before COVID, changing demographics and lifestyle factors, primarily the desire to mean flexibility, was influencing a growing desire, especially amongst millennials and younger people, to rent versus own. And there's been a growing and a greater social acceptance for renting, especially in very popular urban centers where a lot of technology jobs are being created, San Francisco being a perfect example. Market conditions suggested that the rental market was going to continue to grow in these metropolitan areas. Record new inventories were introduced. I mean, just in Oakland alone, last 2 years, there's been 8,300 new apartment units introduced to the inventory, and the demand and rents that were being achieved was significantly robust. Absorption, excuse me, the absorption of these units suggested that development of new multifamily properties would continue, but I think everything's in a pause mode right now. That's in great part due to the reluctance of the capital markets to dip a toe in the water and move forward with new projects, both on the equity and the debt side. The reluctance, I think, is again rooted in the unknown. How quickly will the economy recover? How quickly will these jobs come back? And will people be able and desire to rent places? Vacancy rates have decreased across, or the vacancy rate has increased across the board, but not as dramatically as one would think. The national average suggests that vacancy rates since COVID began have only increased about 3%. and that rent, excuse me, yeah, 3%, and that rents have only dropped about 5%. According to NACREIF, which is one of the institutional sort of monitors multifamily development, they're tracking that things continue to decline in Los Angeles, San Jose, San Francisco, Miami, and New York, while things appear to have bottomed out in Orange County, San Diego, and are actually beginning to recover in the East Bay area, Boston, Chicago, Seattle, Dallas, and Denver. The big unknown, as I mentioned, or the biggest unknown that we're dealing with right now is the impact of local and state legislation as it relates to rent forgiveness and the inability for property owners to evict tenants who aren't paying rent. It's being dealt with differently, region by region, city by city, but it is a situation that might favor and give a lifeline to the tenants, but at the same time, it is going to potentially create some undue hardship for the property owners when it comes time for them to figure out how they're going to pay their monthly debt service. Through the second week of May, if you look at Class A high-rise apartments, they had about 95% of their tenants nationally paying rent. Class B was about 94%, and the Class C garden style, more suburban property, which might cater to a lower socioeconomic base, was at about 90%. And at the beginning of May, those numbers were about 70 basis points lower. I think overall, the multifamily sector appears to be relatively stable, even when you consider the impact of the job disruption. I think leading factors continue to be that renting presents a lower all cost of occupancy when compared to home ownership. And as I mentioned, the growing desire to maintain flexibility and lifestyle factors. A lot of people today want a more portable lifestyle, less clutter, less goods, less things, and having the ability to work and live in a geographic area of their choosing remains very, very popular. There's a growing trend in the multifamily sector that we're seeing, and it is very similar to the phenomena of WeWorks and a shared work environment. And it's a co-living environment. And it's actually spawned a relatively new industry where furniture manufacturers are designing furniture that is much more compact and multi-purpose. Building materials companies are building portable walls that use compression and can split a one bedroom into a two bedroom to create two private bedroom environments. This is a phenomena that is adding significantly to what the potential revenue for a property owner is. Rents, traditionally for a one or two bedroom apartment might be X, but they might be 50% higher than that if you consider a one bedroom is now a two bed apartment, or a two bedroom unit is a four bed living space. The idea of the co-living, I think, is probably a great segue for me to stop babbling and turn things over to David. Co-living harkens back to the days when we were living in a fraternity house, sharing a bathroom, sharing common areas, hoping at one point in your stay you're going to get a private room instead of a room that you shared. But David and Todd Whitlock, who I see is listening intently.
Let me take it from here.
Okay.
So yeah. So on the student housing part, I just want to spend a minute on student housing because it's, although I think it's a topic that probably a lot of, I see guys on the screen who might have children who are approaching. Oh, yeah, take that back. Take that back, Matt.
Okay.
So I wanted to first talk about, many of you know Todd Whitlock, partner who's on the phone or on Zoom call right now. Most of you think of him as kind of an English guy. He's kind of a quiet guy at Cal, but actually over the last years, he's become an architect, and he's adopted a rather, interesting style of architecture. And we decided to partner a couple years ago. This is something that is outside of my work at LVA with my partners. So the partners, we decided to invest with Todd, the architect, and design a student housing project at the corner of Telegraph and Haste. And Todd is exceedingly proud of his design. It's very unique. So Matt, now put the project back on.
Okay.
Yeah, there it is. Todd, do you want to tell us a little bit about your design? Come on, Todd.
Unmute, Todd.
Unmute.
All right, I found it. Can you guys hear me?
Yeah.
It's almost done.
Actually, that bright red component that you see there, that rock is not complete. The painting's not done yet. Just like rock at Disneyland. But this was a architecture. We actually inherited the architecture. This crazy guy named Ken Sarakin who runs Rasputin's, if you guys remember, on the other end of the block. In purchasing this property, I worked on it for 5 years to get this deal done, and we had to build this architecture. It was kind of I think Berkeley side calls it a Moorish Tudor fever dream, which is kind of accurate actually. But believe it or not, the project's obviously very ornate, but it's turning out pretty nicely. David, you can talk more about it, but I'm actually not an architect. I'm a builder. That's my company, West Builders. Has the little banner up there. But yeah, it's getting done, and people seem to love it or they hate it. There's not much of a middle road.
Yeah, I will say that Todd is not an architect, but Todd is a very, very, very high quality builder, probably the most prolific apartment builder in Berkeley East Bay right now as a contractor, and it's been fun to have him as a partner. One of the benefits of the SAE world is getting to not only socialize, but do business transactions with brothers. And Chris Watson and I have worked on a big entitlement deal in Oakland, as well as a number of projects over the years, as well as, for some reason, a lot of the Berkeley SAEs who were not on the smarter math and science path ended up in real estate, and we continually run into a bunch of them around the Dale. But anyways, just quickly on student housing, because it is kind of interesting, again, and relevant to a lot of where we are. Obviously, it's had an impact. We got very fortunate in this transaction in that we were able to address a need that UC Berkeley has. They're obviously very, very underserved in terms of student housing. And so we were able to master lease the entire project to UC Berkeley. So they will be responsible for filling it up with students. We met with them last week, and it's actually fully subscribed. Berkeley, it appears at this moment will have students on campus, probably not as many as they did last time. They're trying to figure it out. I'm sure Rich could give us a lot more information on that. But some of the things we're learning from student housing size is obviously, the triples and quads that we were all probably shoved into when we were there. Those will not happen. Minimum 6 feet of pillow to pillow, bed to bed in rooms. Rooms that were scheduled to be triples are now singles or doubles or singles. And so definitely an impact in the student housing world. And generally, the student housing world is somewhat gotten overbuilt in a lot of places. We are very bullish on the Berkeley student housing market, and actually have some other things we're working on there too. But what I really wanted to talk about more was, and briefly, the industrial world. And as Chris sort of outlined, of all the asset classes out there, certainly hospitality. If you wanted to have a more depressing conversation, we talk about the retail class, because it has just been hammered on sort of all sides. But as I say, my business, we're very active and involved in the industrial side of the world. And if you had to look at all of the asset classes, the industrial side has actually held up relatively well, through this last crisis. And I guess, what have we learned on the industrial side, and just as consumers through COVID? I think we've all learned that we certainly like getting stuff delivered to our house. The other stuff that the stuff that we like to get delivered, we're no longer tolerating a 2-day delivery period. If it's not today, it's not good enough. And we're seeing those delivery expectations getting sort of continually moved up. We have discovered that we like to buy groceries online, and that hasn't always been the case. The segment that didn't shop online now does shop online, and that was a fairly big part of the population. Obviously the millennials here, others were very comfortable with ordering online. A lot of the older generation were not, and what we've seen is that hey, that part of the community has become very comfortable with it. And what we're also seeing is that, hey, there's a huge expectation that those people are not going to want to go back to the retail shopping. And obviously this is having a horrible impact on the retail community. You have to look at Sears, JCPenney, Neiman Marcus, Pier 1. Every day we seem to have a new announcement of another major retailer, that is going back. We're also learning that what's the impact on the supply chain. And if you're a manufacturer of goods in the United States, we developed over the last, probably 15 years, this whole just-in-time delivery concept, which was, all technology driven. And when you bought something in a Walmart store, when you skewed out of the checklist, that immediately sent a message back to China, to the factory, that they needed to produce another one of those, and then it would start its journey through manufacturing and logistics chain to get to Walmart. So when, in 10 days or 2 months, whatever the life cycle of that is, that would be there for you. And that all depended upon supply chains working perfectly and sources all being there. And we're I think realized through this crisis that we can no longer be dependent upon one supply source that is maybe geographically isolated. And I say the terminology that's now being thrown around is, instead of just in time, it's just in case. And just in case will mean that goods and service or goods will be manufactured closer to the United States. We think there will be, we're beginning to see in our portfolio a reasonable trickle of manufacturing that used to be done outside of the United States is coming back in. It's taking advantage of labor and much more direct ability to distribute the product. We think that Mexico will be a big beneficiary of this, as they're closer certainly and seen as less stable. We learned that having China have a stranglehold on several of our key industrial components to be a sole provider is also not a great idea. And that we need to have diversity and resiliency in our supply chain. So what does this mean for industrial going forward? We think the reality is it means that we're going to need more industrial, and we're also beginning to see it in what we're doing, and we've kind of come up with a metric that every $1 billion of additional money that we spend on online sales creates the need for 1 million square feet of industrial space, of online distribution space. And we are increasing our online spending by, well, in fact, the figures aren't quite out yet, but let's just say that there are $100 billion of additional spending going on. The home grocery delivery business I alluded to earlier, pre-COVID, about 3% of groceries, or the world, or the United States, was about 3% of groceries were being bought online. And the prognostication is that over time that people would be buying up to 12-13% of their groceries online. And that happened in 2 months. So we're now at about that level. And that alone will necessitate the need for 200 million square feet of new food distribution facilities around the country. As I mentioned also, the onshoring and the just-in-time, or the just-in-case change to the industrial supply chain. So rather than have most of your warehousing, under the just-in-time model, most of your warehousing is getting done farther back in the supply chain, back in the Chinas, the Vietnams, and that's creating the risk factor though. And so now that inventory will be done more closer to the US, either in Mexico or actually in the US, which we think will have a significant impact on the demand side of industrial in the US, and then as well as the manufacturing piece, which will be coming back in. So again, all things where Chris was super negative on the impact on hotels, the industrial world is actually, I won't say it wasn't impacted, because it definitely was impacted, but there might be a silver lining out there. I want to switch real quickly to the office world, where we're going to transition with Motley. But just from the owner developer side of the office world, pre-COVID, we were focused on building and buying and repositioning sort of transit-oriented projects, dense, urban, walkable areas. This is where the millennials and all the new talent wanted to live, they wanted to work. They wanted to be in creative environments with sort of dense workspaces, hoteling, shared workspaces, big, great amenities. Now, post-COVID, we're trying to, this is kind of a work in progress, but from the perspective of the user, a firm that we do a lot of work with is Gensler. And Gensler is probably the premier architect on behalf of corporate America. And they just last week came out with a study that they put together from questionnaires. They went out to 2,300 of their clients. And the clients were all, pretty evenly split between, millennials, baby boomers, between managers, between, associates and interns, mid-level managers, and also geographically around, and this was a US study. They've also done the same study in other places. But I thought it was sort of timely, as we all sort of put our own parameters around how we were choosing to work during this time frame. But it was somewhat surprising to say that only 12% of the workforce would want to work full-time at home. 70% would choose to work a majority of their time in the office. 30% would want some more flexibility in their work. locations and ability. And, the question is, hey, why is that? Probably self-obvious, but, the socializing, the connecting with people, the part of the community, it also was sort of stressed pretty clearly along age, that the younger people, much more desirous to be in a social environment, to connect, to have a sense of community. And I think for their own personal growth also. The older people, like some of us, feel more accomplished working at home, more efficient, don't have the need for maybe some of the social interaction and perks. We got over that much younger. So I think, but as I looked at it, and I look in our firm, I think it's the younger people who really should be in an office, and I think the older people need to be there also, because that's how you're sharing information and knowledge across generations and different work experiences. So it'll be easy. It'll be interesting to see how that plays out. But we are beginning to see in a lot of our areas that workplaces are opening up. Chris and I are actually in my office in Del Mar, California, where we've been back to work for a while. The other thoughts are around, hey, what will happen when we do come back to work? There's lots of different planning that's going on, not only on behalf of the tenants who have their own employees coming back in, but on top of the building owners. And, lobby check-ins, wellness screening when you're coming into the building, elevators, queuing with spacing, limiting, direct interaction, more use of fire stairs for one-way exiting, probably more focus on lower floors, less buildings with elevators, a lot of focus on building systems. How are we cleaning the air that everyone's breathing? More importantly, how are we circulating the air? Are we just recirculating, bad air? Or how many turns of air, how many fresh air turns are we getting into the buildings? These are metrics that have not been seen as important, I'd say, in the office selection criteria, which will be more. The other is cleaning. I mean, we will see, if there's an industry that I want to invest in, it's the cleaning businesses. I think we're going to see a ton of higher end, expensive, diligent cleaning. Less desirable office configurations, less shared people spots, all the things that seem to be hot buttons. Conference rooms, not being able to get together all in conference rooms. Conference rooms will all be limited by size. I think you'll have conferences where you will have 4 people in the conference room, of course, spaced appropriately, and then you'll have another 8 people in the same office who will be zooming in or electronically connecting. Outdoor areas will become important also in climates that allow it. Having operable windows and airflow, again, will be important. With that, I'm going to turn it over to Steve Mott, who knows a few things about these areas, and we'll be back for Q&A.
Yep. Thank you, David. Thank you, Chris. That was great. Much appreciated and good information. And thank you to all that are on the call today. So we do overlap a little bit, David and I, and there are some things that are happening in the commercial real estate world, office space. If we were to look at San Francisco as a touch point and talk about some of the things that are happening there, I know it's not necessarily the norm, or it doesn't translate necessarily to other parts of the country or other parts of the world. But I know in San Francisco, when you're talking about occupants going back into a space that has been, let's say, empty for 3 months, there are some concerns. You want to be sure that it is clean, like David said, and you want to make sure that when you, as the building owner or the building operator, when you're bringing people back into the space, that their concerns are met and that they have some level of comfort for working in the space where they used to not even think about it. And now, and David's right, it's about clean air exchange and maybe upgrading your filters on your rooftop units to HEPA type filters so that it does filter out a lot of that number one, pollution, and number two, virus. There are filters that will do that for you. And lighting is an issue. If you want people to feel like they're not under a fluorescent light all day, you're going to change out and get some LEDs or get some softer lighting and make sure that people have a little more of a comfortable space and that they're not anxious or stressed out at work, because we all know that leads to a non-productive employee. So safety and security really are what we're talking about, and to make sure that when you're coming into work, if your building has been prepared for this reoccupancy, they've got all the signage up and they've got the sanitation stations where you can always have some Purell for your hands, and they're going to hand out masks. I think in a building where you don't know who's coming down the hallway, you probably want to wear a mask. So all those things need to be set up ahead of time, and some of them are low tech, some of them are high tech. A whole lot of the discussion now is around making sure that your emergency response plans are in place. If you're the building maintenance engineer or the director of facilities, we want to be sure that you're talking about how you can get people out of a space in an emergency, not just a natural disaster, but in the event of a disease type that could be either a pandemic, another wave of the pandemic, or it could be something along the lines of a dirty bomb, or God forbid, even a active shooter. So all that has to go into effect ahead of time, and as soon as in this case, as soon as the pandemic hits, you want to start planning for getting back into your space and getting it clean, getting it sanitized, getting it ready, and putting into motion all the different aspects that you have for safety and security. And that might be pest abatement, making sure that you've cleaned out those floors that haven't been touched. You want people on the roof to make sure that all your air intake screens are clean. You might even want to add cameras up on the roof or in some of the equipment rooms, and you can start looking at these things remotely. It's a very good chance that your facility staff will be downsized, as always happens in an event. But if you've got less people, or if they're working split shifts or part-time, that kind of thing, you want to be able to use technology to your advantage to have direct access to things like the elevator control room or the generator, the backup generator, and the fuel tank and that kind of stuff. Who knows what a COVID claw is? You may have heard of a COVID claw. It's not, your fingers aren't permanently like this from being on the phone at home, but it's actually a little plastic device that you can put around a door handle and turn it without touching the door handle and pull the door open, which makes a lot of sense. A lot of people are going to try to go to touchless. First of all, for your front door and for the elevator control buttons, and then doors down hallways or in the bathroom. If things are cleaned, you might have a good sense of that you're not going to run into somebody that necessarily has the disease, but you certainly don't want to take your life into your hands if you're out there without a mask or without the gloves or the tools you need. And David mentioned a couple things. They do check temperature, body temperature when you come in a building. They can also check your blood pressure, and they can see who's sick. And that leads me into the contact tracing apps You know, is this Big Brother now? Are we going to be responsible for giving all of our personal and private information to somebody to compile it and determine who's sick, can come to work, who can come into the office and who can't? You know, I think a building with 3,000 people in it, they may want to know who potentially might be infected. You know, there are RFID sensors that you can track people's movement. Your phone, the smartphone is called that for a reason, because it can tell an awful lot of information about you, where you've been, who you've been next to, all those kind of things. So that leads just to a whole bunch of privacy concerns, and I think there's things that need to be worked out. I think there's ongoing discussions around some of this stuff. I know OSHA has instituted new regulations for training and updating your policies, and then also enforcing the recording of COVID cases in a workplace. So, you know, all those things begin to sort of add up, and as long as people are willing to go back to work in the office and feel comfortable doing it, you know, maybe we can get to a sense of normalcy. But I believe that with the 6-foot distance requirements in offices, you're going to have fewer people in the same number of square feet. So maybe you need to take more footage if you expect people in, or you need to set up timeshare for desks and things, and make sure they're clean in between. You know, other considerations, of course, are deliveries to a building, and the mail delivery, and the supplies, and food for your cafeteria, or if there's somebody there who's doing your food service, you better check them and your janitorial company and make sure they're all following procedures and not introducing something into the space. So I know we're tight on time, and I don't want to go too much over, but software is the key, and software on your smartphone is going to be more and more, let's say, helpful in tracking some of the things that you're doing and being able to do your job more efficiently. So we're talking artificial intelligence, the mobile solution, those kind of things. David touched on it. I think Watson did too, but really now we're talking about how home offices are competing more directly with commercial office space. And I think people are concerned that going back in isn't necessarily the best thing for them. If they can work at home, that gives them some latitude for where home is. I think people are moving. There was an article in the paper this morning about some properties in Napa. Again, not necessarily the best example, but there's some high demand for spaces outside the city where you can work from there and not necessarily have to be in the city where you know, the risks could be higher. So I'll leave you with that, and certainly there's more for discussion for another call probably someday, and we'll take questions.
Guys, before we go ahead, so if you want to ask a question, you'll notice there's a chat feature on your thing. At least put your name there so I can call you, or you can put your question in there if you want as well. I'm going to start this by just also letting everybody on the phone know one of the other things that we're rolling out with the undergraduate part of the chapter is we're going to late summer, early fall, start rolling out a mentoring-mentee relationship. We're going to actually have some software in place so people can sign up for a one-time career shadow discussion, or they can actually agree to a mentoring relationship. We're going to continue to do some speaker series, but some of the stuff in the school year might be the chapter meeting will be turned into a panel discussion on a certain career subject. So the bottom line goal out of all of this is to just create more value for the undergraduates. In today's world, we've got to give more value to mom and dad and the students to join the fraternity, because, you know, right now our social restrictions are going to be in play here for at least a little while. So there's going to have to be more that we offer. So let me see. I've got one chat that came through from Rich Lyons. Okay, it's you, Rich.
Well, thanks to all three of you. That was super helpful. I think just real quickly, the opportunity side of this very, very difficult time, I can only imagine that ARC, Motley, is an even better product now than it was 4 months ago. And if I'm thinking about Chris and David, you know, I remember in past downturns, you got these vulture funds, right? People looking at whatever. If you think hospitality, or many of them are going out of business, I'd imagine there's some extraordinary opportunities. Could each of you just touch on real quickly kind of maybe some extraordinary investment opportunities that might even be available to the rest of us?
Well, let me take a stab at it. I think you know, the two asset classes within the real estate sector that are most immune to cyclical fluctuations, that I would put COVID category, are multifamily and industrial. You know, they're both protected by, you know, low cost to re-tenant in the multifamily space, multiple credits, you know, based on the multiple tenants that you have in the building. So, you know, they're going to experience potentially a blip, but they should do very, very well over the long run. And I don't see huge opportunities. As it relates to the hotel sector, the hospitality sector, and as David alluded to, the retail sector, yes, I think there could be some significant opportunities. You know, the phenomenon that's occurred over the last decade is that a lot of the major hotel brands have not been the typical real estate owner. They've sold their underlying assets to hospitality REITs. So they're getting away from the ownership side and focusing on operations and management. Many of these REITs are extremely well capitalized. And as I said when we were talking earlier, these well capitalized brands should weather the storm fairly well. The challenge for both retail and hospitality is going to lie municipality by municipality, and whether or not they're willing to consider an alternative use for hospitality or retail space, because both generate significant taxes for those local municipalities. You know, we're seeing changes already in big box retail, where some of these retailers that have gone out of business, the space is being adapted for more of an industrial use. David alluded to the fact that online grocery shopping is becoming a big business, and I could see, you know, a Penny's or a Sears store being converted as a distribution facility and potentially have a client-facing component to it for grocery sales. Hotels, you know, David, Todd, and I have talked briefly about the possibility of converting hotel properties into multifamily residential. Could be very, very quickly done. You know, Todd's astute at looking at what kind of things need to be done from a conversion standpoint to make it a standalone unit with a kitchen and bathroom facilities, etc. But again, you know, you're fighting an uphill battle because the cities will be very, very reluctant to forego those revenue opportunities on a go-forward basis.
Yep.
David,
Thanks.
thoughts?
Yeah, the only thing, Rich, on the, I mean, as Chris sort of alluded to, that's something that everyone can invest in. The stocks that have been most beat up of all of the real estate stocks have been the retail stocks. And I think if you really drill down on a lot of the publics, the Simon Malls, Brookfield, Westfield, one of Sump's Australian, you know, companies, those guys are not dumb guys. And by definition, a regional mall is in a location that is super, super central to a whole bunch of population. As Chris alluded to, I mean, we're looking at some of those situations to see if there can be conversions into sort of last mile distribution. But there are a lot of other models out there also where people are really looking at all those big parking lots and should they be, you know, multifamily housing? I mean, and there will be a whole new genre of retail that will be much more experience based that you can't get online. I mean, you'll see conversions to you know, different kinds of uses that we haven't seen yet. So
Those are great. Great.
might be
Yeah.
Great.
time cheap.
Much appreciated. I just want a quick shout out to Todd Whitlock and to you, David. That property, that lack of property on Haste and Telegraph has been an eyesore in Berkeley for literally decades. I don't need to tell you that. So hats off to you for making that happen.
By the way, Todd's middle name is Gowdy.
Hey, I got a question. How about right to our own homes, our fraternity houses? What do you think is going to happen there? So if you look around the U.S., the numbers are still, the demand to be in fraternities and sororities continues to stay high. And you got campuses like mine here at University of Arizona that the sororities have hit 350 to 400 members a chapter, but they're in sleeping porches quite often. They got dining rooms that 200 to 300 are eating in the same, you know, the same dining room. Those that have bedrooms have 2 to 4 in a room. They've got shared bathrooms. What do you think what's going to happen there?
Well, I was thinking that, and really only as it pertains to our SAE house. I mean, our SAE house is actually, this should be a big recruiting, you know, cell, in that we do have a very high preponderance of single family or single rooms. You know, we're not congested. We got a lot of open cross ventilation, quad. We're a very, I think we're the safest fraternity in the Berkeley campus. But there will definitely be some changes, and I'm not sure how that impacts those huge 300-person sororities where, you know, everyone's got to get together in a meeting room. There are just a lot of things that are not known right now.
Anybody else got any questions? You can unmute yourself.
Actually, I have a couple, and great job, guys. One is, you know, I have a lot of multifamily product that I own, and I've been pleasantly surprised with a pretty low additional rent or lack of rent paying for people with COVID excuses, I'd say. But after what happens in the next couple of months when maybe all the subsidies from the government aren't still in place, do you guys envision seeing a big increase in that? And then just the second question is, so maybe in the next 6-12 months, we get a vaccine, everybody gets vaccinated pretty much the same time, and we get to move on. But in the meantime, we've done a lot of things and made a lot of changes on how office space is laid out, densities, et cetera. And do you see that kind of continuing into the future, or will we maybe spring back to what we were doing in the past?
Terry, I think, you know, when I was going through some of the numbers, I was surprised at how little rents had dropped and how little the increase in vacancy had risen. And I think it's to be determined how long the economic ramifications of COVID last to see, you know, what the long-term impacts are for property owners. The approach we've taken at properties we own is to have each tenant that requests any form of rent relief that they fill out a very thorough application, and it involves, you know, looking at their bank statements, their credit card statements, whether or not they've applied for PPP financing. And we're trying to be very even-handed and fair with everybody. So it's an across-the-board questionnaire. And we're dealing on a case-by-case basis with each tenant to basically help them through this tough time. And I don't think we've seen a situation where both commercially and residentially, we've had tenants that have said, hey, forgive my rent. It's more of a please defer my rent and give me a payment program that I can live with. So I think it's a genuine need, and I think people are trying to react accordingly. I've spoken with a couple of facilities managers for large technology companies, and I do think that some of the changes that are being contemplated are long-term changes. Mott alluded to it. I think the days of trying to pack 8 people per 1,000 square feet are gone, and we're going to get back to the historical norm of maybe closer to 4 per 1,000. I think that many companies are adopting a policy where people are not required to come into the office 5 days a week. My daughter works for Google, and she is working remotely right now. But when they do go back to work, she's been given the flexibility to go into the office 2 to 3 days a week and work remotely the rest of the time. Facebook announced a couple of weeks ago that, and Twitter also the same, that their employees are free to work remotely for the rest of their careers with those companies. And if they, relocate out of the Bay Area into a more less expensive location, their compensation will be adjusted accordingly. So I think this has been a wake-up call, and I think that technological changes are here to stay. And I also think that from a fundamental how do we work perspective, things have changed as well.
My only comment on that is, and I maybe have a slightly different take, is that I look back when 9/11 happened, and nobody was ever going to go to New York again. Nobody was ever going to be in a high-rise building again, and the scar that was left was so permanent. But yet, it took some time. But in 2 to 3 years, 2.5 years, what do you know? We built the world's tallest building on the exact site that, the plane went into. So I do think we have a shorter memory, and I think a vaccine, if you can eradicate this somehow, I look at, we're in San Diego, which has been a little more open, less locked down, because really we've had a lot of lower incidence, although the Bay Area hasn't had significant, recent activity. Even as things have opened up, things have become much freer. So I do think that we will bounce back to a more normal comfort level quicker than later. But I do think that a lot of the things that, a lot of the technology, a lot of the air filtration, a lot of the cleaning, a lot of the, the distancing will continue on.
Great. Any other questions, everybody? We're a little bit past. So I know everybody's got to probably head somewhere, but Rich, did you have another question, Rich? No. Okay. So, well, I think I appreciate the speakers today. Great job, guys. I think we all learned something. Now we're all trying to think, okay, what am I doing with that money that I need to invest right now? Where's it going? Thanks for your time today, and you'll see the next couple promoted here over the next couple of weeks. Thank you very much.
Well done. Go Bears.
Bye, Alpha Bros.